Welcome, everyone, to today's program. I am Laura Dierda, Editor-in-Chief of Becker's ASC Review. The program will begin with a presentation, and we will have a question and answer session following the completion of the presentation. You can submit any questions you have throughout the presentation by typing them into your control panel in the space labeled Enter a Question for Staff and clicking Send. Our presenters will attempt to answer as many questions as they can during the time we have, and will follow up on questions they do not have the opportunity to address. You will receive an email within about a week following the webinar that will include instructions for how you can download a copy of the presentation. You will also receive a follow-up email shortly after completion of the program. You can submit any feedback or any additional questions you have at that time. This email will not include the presentation. It is now my pleasure to introduce today's presenter, Todd Mello. Mr. Mello is a partner and co-founder of Healthcare Appraisers and manages the firm's Colorado office. Mr. Mello has over 25 years of healthcare finance and valuation experience, the last 15 of which have been spent building healthcare appraisers to become one of the nation's preeminent valuation firms, focused exclusively on the healthcare industry. Prior to founding Healthcare Appraisers, Mr. Mello served as the Vice President of Business Development for a national neuromuscular physician management company, during which time Mr. Mello managed the due diligence and acquisition function of the company, as well as the syndication and feasibility of subsequent outpatient surgical center development. In addition, Mr. Mello has been responsible for providing physician acquisition-related consulting and diligence services and corporate financial analysis services within the consulting and publicly traded managed care arena. It is now my pleasure to turn the floor over to Todd Mello to begin today's presentation.
Thank you, Laura. I appreciate it, and I appreciate everybody dialing in today. Why don't we turn the slide? Let's start with, I have reviewed the prospective attendee list, so I know there's several folks, or a number of folks out there that perhaps are valuators or consultants that do valuation work, etc. So my little disclaimer here is today we're going to gear the presentation more towards the non-valuation expert audience, those folks that are operators or within health systems that own surgery centers, etc., and kind of a high level of issues to be aware of if their center is being valued, not necessarily if they're valuing their own center. So in terms of the outline today, we're going to start with our standard of value in healthcare, and then we're going to go through the 10 common mistakes, and then as Laura mentioned, there will be time for questions and answers. So why don't we go to the next slide? Thank you. Okay. I'm not going to read too many things today, but this is one slide I want to read, and then I want to explain it a bit. I think most importantly, the standard of value and the assumptions that are related to that are what govern our valuation within healthcare and in surgery centers, of course. So there's some slight differences in the definition of fair market value for healthcare as opposed to non-healthcare settings. So as the slide mentions, it's the price at which property, in this case, equity in a surgery center, would change hands between a hypothetical willing and able buyer and a hypothetical willing and able seller acting at arm's length in an open and unrestricted market when neither is under compulsion to buy or sell. And here's the difference within the healthcare definition between well-informed parties who are not otherwise in a position to generate business with the other party. So I think the implications of hypothetical is really where I want to focus and try to make this definition make more sense. So if we go to the next slide, we'll get into that. Okay, so one of the biggest mistakes I do see is this concept of confusing the standard of value between fair market value and investment value. So going back to the definition of fair market value for a minute, it really is hypothetical. Doesn't mean someone who, hypothetical party to buy a surgery center wouldn't be a chemist necessarily. We're talking about hypothetical parties. Those would include hospitals, business folks, private equity, physicians, management companies. So you basically identified a pool of folks or parties that generally would be buying centers. And that's really what we mean by the term hypothetical. And what we want to avoid when we're valuing anything in healthcare and surgery centers is basically getting into the realm of strategic value, which is where we try to take things into account which are very specific to one buyer or one group of buyers. For example, the first bullet point here talks about the hospital buying a surgery center outright, so 100%. And sometimes there's confusion about, well, the seller understands that as soon as the hospital buys that surgery center, they're going to be billing the surgery center procedures and cases, etc., at a hospital outpatient department fee structure, which is generally higher than what we see billed within the surgery center on a freestanding, independent, non-hospital basis. So that's something that we just can't take into account. That's something that the buyer brings to the table, and that's something that only a specific group of buyers bring to the table. So, for example, hospitals may be able to do that, but other hypothetical buyers, such as management companies or private equity, etc., business folks or other physicians, they're not able to bill under a hospital fee schedule, nor are the sellers. So that's something that would be a violation of the standard. That would be investment or strategic value and not fair market value. Another example, and related to that, would be basically overlaying the hospital's payer contracts. So many times hospitals are able to secure better payer contracts on an outpatient basis. So we're not talking about hospital-based fees, but we're talking about CPT code billing, or like a surgery center would do on its own, but many times a hospital may have market clout, and one of the questions would be, well, why not overlay that in the valuation? Why not essentially increase revenue to reflect the fact that that specific hospital is going to be able to get better reimbursement? Again, another violation of the fair market value standard, and that's a strategic investment value standard, which, by the way, it's fine in any other industry outside of healthcare. We just have a regulatory compliance issue with healthcare, but those are the types of things that we don't want to see happen. Similarly, a specific overhead structure. If you've got one acquirer who's able to leverage their overhead and onto a particular target, and they're able to enjoy a much lower overhead percentage, that's great, but that's just something that's so specific to one party it would violate our standard. Sometimes you might see a hospital that wants to buy a surgery center for purposes of closing it down. Well, one might think, well, then the center's worth nothing if we're closing it down. Well, not so. The center's worth, regardless of what that specific buyer wants to do, the center still has a certain value. So again, common problem we see is confusing that standard and value. Why don't we move to the next slide? Okay, number 2, blindly, underline that term, blindly applying valuation multiples. As some of you may be aware, each and every year we publish a survey of multiples observed within the ASC market, and I have included those multiples, several slides from our recent survey at the back of this presentation. So to the extent, we're probably not going to have time to go through that today, but to the extent, as Laura mentioned, to the extent you'd like a copy of the presentation, then those graphs will be set forth therein. I think we have our disclaimer in our survey, and the market multiples are good evidence of what general market multiples of what is occurring within the industry for both controlling interests and for minority, individual non-controlling physician buy-in, buy-outs, those types of things. It's important to understand what a multiple is and then when it's appropriate. So here we'll keep our math exercise to a minimum for this purpose of this presentation. But really, here what we're seeing is a multiple is 1 over K minus G. And K is basically risk. That's the amount of risk associated with an investment. And G is the growth rate. So if we go to the next slide, I've got basically 2 sets of scenarios. One is where we vary G. In the first set of columns there, we're leaving K or risk the same at 17%, and we're varying growth 2, 3, and 4%. So you can see as we increase growth, the multiples moving from 6.7 roughly to about 7.7. In the second set of slides, we are varying risk and leaving growth the same, and you can see as risk increases from 17 to 22%, in scenario 3, you can see what happens to the multiple. It decreases from 6.7 to 5 times. So if we go to the next slide, I mean, so when folks say, well, you know, what's the multiple? What multiple do we use to value a center? I mean, you know, do we as evaluators look at multiples? Absolutely. A lot of the time they're a secondary type of valuation analysis. And we're going to have another point where we talk about our valuation conclusion with respect to general market trends and multiples, and whether or not that should trigger you if your valuation answer seems completely absurd relative to where the market multiples are trading. We'll get to that point in a minute. But here's a slide I show quite frequently during presentations, which is where we have 3 surgery centers as of a point in time with the same EBITDA, or same earnings, cash flow. And you can see what, if we have surgery centers that are trending, like, for example, in the blue, trending from higher EBITDA to lower projected EBITDA over time. And then we have one center that's essentially estimated to roughly approximate the same EBITDA on a go-forward basis. And we have one that's increasing. I mean, clearly each one of those would dictate a different multiple because we have different growth and different risk. So why would you pay a 7 times multiple on a center that's, for example, the blue graph, that's expected to go down over the future? Multiples, again, should be taken with a grain of salt. We do look at them in connection with other valuation techniques, but just grabbing a multiple out of the air and applying it to an earning stream is not a valuation. So why don't we move on to the next one? Incorrectly specifying risk. This goes back to the comment I just made, that closely related to the prior. So while multiples can be misapplied, there is also risk at arriving at a conclusion that doesn't make sense, assuming no material adverse risk factors. So for example, if somebody's valuing a surgery center where you're coming up at a 15 times multiple at the end of the day, you know, generally speaking, you might scratch your head and say, well, I should probably go back to my assumptions and see what I've got in there, because that really doesn't make sense in light of where the market general guidance is. And similarly, you know, what if you come up with a 3 times multiple? Well, maybe if you're an out-of-network center, we'll talk a little bit about that today, maybe that makes sense. But these types of things, I think those market values, those market multiples should be used as a general litmus test, but again, not as a standalone valuation technique. Why don't we go to the next one? Okay, I mentioned this a minute ago, failure to specify out-of-network risk. Risks associated with out-of-network surgery centers can oftentimes be, you know, misunderstood. I was involved in a divorce case with an individual on the other side, the other expert, who had never valued a surgery center before, and just didn't understand that this particular center that we were valuing on different sides of the litigation was completely out of network with commercial payers, and hence more risky. And and that risk that I'm referring to is really associated with uncertainty around, well, if, when, and how much rates will be reduced. As an evaluator, we have a couple ways to deal with this uncertainty. If, as bullet point 3 suggests, if we have reasonable certainty as to when a conversion from out to in-network might occur, we as evaluators are better off modeling that specifically in the cash flows, as opposed to the other technique we have, which is essentially saying, well, we know the center is out of network. We're not exactly sure if, when, and how much rates are going to be changed. So the only way we can really deal with that is by increasing that amount of risk or the discount rate. But let's go to the next slide. All right, here's an example, make-believe, whereby in year 2, you can see that the net revenue per case drops from $4,700 to $3,000, suggesting that gone in network with the primary payer. And obviously, net revenue drops as a result. But case volume in this particular case actually goes up. It's not uncommon for when you go in network with a payer or for your case volume to go up, because all of a sudden now the members of that particular managed care planner, it's a lot easier and permissible and less out of pocket for them to go to your center. So, but for purposes of this illustration, again, if I'm projecting out cash flows for a surgery center, if I have reasonable certainty as to, what I mean by that is it's not uncommon for centers to receive a letter from payers and be going back and forth, whereby there's a date certain where things are going to change. When we have that idea as evaluator, then we're better off modeling that specifically into our forecasts, our projections, as opposed to just tagging the center with more risk. Being out of network, does it always mean it's just automatically more risk? Well, not necessarily. I have valued centers whereby they're the only center in the market, and there's a hospital player in the market, and the hospital, even though the center is out of network with certain commercial payers, there's still a cheaper alternative to the payer than having the patients go to the hospital. So as many things are, it's always fact and circumstance specific. You just can't assume something without knowing what's happening within the particular market. Why don't we go to the next slide, please? Okay. Another problem we have, so we talked about multiples, multiples of EBITDA. Well, EBITDA, earnings before interest, taxes, depreciation, amortization, that's a cash flow, so an earnings measure. And many times when we're valuing, we need to make certain that our earnings stream, if we're doing a market approach and we're doing our discounted cash flow analysis and our projections, we need to make certain that we normalize the earnings stream for one-time, non-recurring, atypical expenses. And these types of things could commonly include perhaps a center had a malpractice or a shareholder dispute in a certain year, and as a result incurred significant additional legal, accounting, consulting, etc. And I'll show you a numerical example in a minute. That's the types of things where as evaluators, and if you're looking at your center, say, well, that's not reflective of what's going on, what's expected to happen in the future. Therefore, we need to normalize that, essentially reduce that expense down to typical normal levels. And that adjustment, by the way, can go either way, and it can also impact revenue. If you're a cash basis, you have cash basis financials. There may be a recovery of prior receivables, dating back several years in 1 year, and those are the types of things that can distort revenue and distort your EBITDA calculations. So those are the types of things we would remove. If a center is not billing Medicare appropriately, I've seen this happen. Those are the types of things as part of the valuation that we essentially could give the center credit for by making an adjustment to the revenue of the center. So if we go to the next screen, please. All right, so again, simple example of 3 years of actual results from a make-believe center. And you can see that in 2015, professional fees jumped from $75,000 roughly to $500,000 to make my example really easy to follow. And EBITDA, as a result, dropped as well. So that would be something where even applying a multiple or using that as the base year in your forecast for a discounted cash flow analysis would not be appropriate. The evaluator needs to go back and fish these inconsistencies out, work with the center's accountants and management team, et cetera, in identifying whatever adjustments need to be made to normalize the earnings stream of the center. So in this case, we would basically reduce that amount under the assumption that that's not representative of the go-forward professional fees. Next slide, please. Okay, another common mistake is an income-based valuation technique. Could be a multiple, could be use of multiples, which is basically a combination of market and income. It could be discounted cash flow at the time of the inception of a surgery center. So while ASCs routinely create forecasts at inception, it makes perfect sense, which allow owning parties to develop some idea as to what the center could look like over time under various scenarios. That makes perfectly logical sense and should be done. But what you shouldn't be doing for a startup center is basing your price of your shares or your units based upon what this forecast may show you. It's just way too speculative when it comes up. When you're starting out, your forecast is oftentimes based upon what physicians are telling you they think they can bring to the center, based sometimes on what they're doing somewhere else, and sometimes based upon just kind of rough estimates. And so that would be very speculative. and generally would be inconsistent with market pricing. So the way that typically should be done is using a cost approach. It's no discounted cash flow, no multiple of earnings, basically identifying in detail all the required costs, TI, tenant improvements, furniture, fixtures, equipment, working capital, not only for the after you open, but there's a pre-opening period to obtain licensure and certification, et cetera. You need to bring on staff months ahead of time. And then finally, with decisions with respect to how the parties involved in the surgery center want to finance it. So you come up with your project costs, and then you decide, well, how much, if any, do we want to borrow? So let's assume our project costs are $5 million. You've got a fairly sizable center. If you're looking to borrow $2 million, then the equity of the center would be $3 million, and essentially it's a fairly simple math exercise, and depending upon the number of shares and coming up with your price per unit. So, sometimes there may be other intangible assets that are involved in a startup center, such as a certificate of need, a CON. Those need to be valued as well in coming up with that, essentially what the cost of that, the value of that center is under a cost approach. And similarly, if y'all are pricing shares in an existing center, let's say there's a new surgeon that's coming in that's looking to buy in, you would not roll his or her cases into the center's projections in order to come up with a share price for that particular doctor. That physician is buying into an existing cash flow stream without his or her case volume, and that's the way you want to value it. It gets a little bit muddy if a person's already doing cases there. At times, many times they'll just do a few to see how they like it. So, but generally speaking, general rule, that's something you would not want to do. Let's move to the next slide, please. Varying share prices for MDs, and what we're really talking about here is around the same time period, based on expected contributions. Now, perhaps that's completely logical to everybody on this phone call because everybody's very familiar with the healthcare regulations and laws and et cetera. But, sometimes accountants, et cetera, folks that don't generally practice within the healthcare industry are just not aware of the constraints and the regulations and et cetera, et cetera. So I've seen this, and you want to be careful about that because the center at the end of the day is going to be on the hook for that. And, while there's no correct answer, the same time period that I'm referring to should generally not exceed 1 year. In certain cases, it could be several months or less. Now, let me explain that. I mean, if you sold units to a physician in December of 2014, and then we're doing another round of syndication in March of 15, and between December and March, there had been a significant, material adverse event, such as a loss of a significant group of surgeons who perhaps went off and did something else, were employed by a hospital, and you lost 4 sports medicine doctors. I mean, everything else being equal, that would be a substantial reduction in revenue and earnings for that center. So come around to that next syndication, you would say, well, you know what, the valuation I just got done 3 months ago no longer makes sense because we had a significant material adverse event. Now, it can also go on the other side. It may have been a very, very positive event. Maybe a payer contract renewed at a substantially better rate, et cetera, those types of things. So the short answer is that if there's been a material change between syndication rounds, you might want to consider getting an update to the valuation. You shouldn't have to redo the whole thing from start to finish, but an update. And again, if you're offering shares to docs around the same time, and no major changes have occurred, don't be picking and choosing. This guy I like better, he brings more cases, so I'm going to get him a better deal, et cetera. Those are dangerous waters. Number 8, please. Okay, a little bit more technical valuation terminology, mismatching of invested capital and equity earning streams. So what's invested capital? Invested capital is the total amount of capital that was essentially put into a company by both equity holders and bond holders. So it's essentially the value of the equity and the debt of the business. And that's typically the way many times we're valuing invested capital first, and then we'll arrive at equity by subtracting debt. So another thing folks do sometimes is they'll essentially use an invested capital multiple, which is the EBITDA multiples that we've been talking about a little bit, and they'll apply that to an equity earning stream. And let's go to the next slide and try to make more sense of this. Okay, so a couple multiples here. Let's assume that we vetted those out. Those aren't just grabbing them pursuant to my prior discussions. And that we've got normalized again, so we've made any normalizing entries, EBITDA of about $2 million. We have net income before tax, so essentially the difference in this example would be $500,000. That would include perhaps that would include interest on this debt of $4.5 million and depreciation, etc. So you can see that in the middle of the slide in bold black, the value of invested capital is essentially the $2 million times each of the respective multiples, low and high, so we've got $12 to $15 million. It doesn't end there. If you do have debt, you need to subtract that, the 4.5, in arriving at the fair market value of the equity on this particular case at 100% level, so 7.5 to 10.5 in that particular example. On the bottom here in red, that's a mismatch, so this is a case where the person has applied an EBITDA multiple of 6 and 7.5 to net income of 1.5, which is, so with the letters there, you're applying A times C rather than A times B. So common mistake, perhaps less common than some, but something that you need to be on the lookout for. Why don't we go to the next slide, please? Love limitless capacity. We can just increase cases to the moon. We won't have any incremental expenses. We have unlimited OR space, recovery space, pre-op space. We don't need any more equipment, so on and so forth. If we go to the next slide. Okay, another make-believe example. Let's assume this is a 2 OR center. You can see how in between 2015 and 2016, cases jump from 4,100 to 7,500. Depending upon the types of cases, unlikely you're going to be doing that many cases in 2 rooms. And you can see down there on the bottom of 16 that the capital expenditures are $100,000. So which is consistent with the other 3 years. So let's assume that this center has the ability to expand into existing space, but it's going to take some money to do so. $250, $275, $300 a square foot to build out more space from shell. You've got possible equipment needs. So the point of this discussion is that if it's even possible, we start increasing case volume and revenue and earnings within a center. We need to make certain that we have adequately, appropriately accounted for additional incremental capital expenditures involved in essentially expanding the capacity of the center. Why don't we go to the number 10? Okay. Failure to make other necessary valuation adjustments. I've listed 2 primary ones here. One has to do with respect to taxes, and the other has to do with respect to working capital. With respect to taxes, it's not uncommon for not-for-profit healthcare acquirers to buy surgery centers, and one could reasonably argue, well, the buyer, they're not paying taxes. Why are you tax affecting my surgery center when you're valuing it? And it goes back to the standard value, as you may recall from point number 1, where fair market value would imply value to a pool of potential buyers, many of whom may not be not-for-profit, etc. So by doing that, it really implicates a couple issues. One, you're crossing the line from fair market value to investment or strategic value, and then you're also the other issue that's implicated is that it's a common argument. Well, my surgery center is what we'll call a flow-through entity. It doesn't pay corporate level taxes. So what we're talking about here, predominantly these days, are LLCs and partnerships and S corporations. LLCs are probably the most common. They do not pay corporate level taxes. However, the owners eventually are having to pay a certain level of tax once they take the distribution. So everybody pays taxes pretty much. So not to mention that if somebody's building up a risk factor or a cost of capital or a discount rate and looking towards certain market-based inputs that the appraiser might look up in various research manuals, etc., all those rates are after tax. So by not applying an after-tax cost of capital to a pre-tax cash flow, you're mixing apples and oranges. Let's go to the next slide. Okay, so in this particular example, I think it's the same projection, or I may have used in the last slide. You can see in this case, while we're here, that the capital expenditure line down below, I did actually, in this particular case, correct for the issue of not correctly accounting for the incremental capital expenditure. So I try to carry that example forward. But you can see here that income taxes are noticeably absent, and as a result, free cash flow is materially overstated. So make certain, and again, this is something that the appraisal community is consistent on, that taxes should be applied. There is some disagreement in terms of what tax rates to apply to flow-through entities versus C corps are fairly straightforward. You're 40%, et cetera, 39.6, whatnot. But flow-through entities that don't pay entity-level taxes, should we apply a C corp rate to them? Should we do something different? We at healthcare appraisers do something a little different, but the technical side of that's beyond the realm of this particular presentation. But and also one other area, another necessary valuation adjustment. When we're valuing the equity of a surgery center, we assume that there's a quote-unquote normal level of working capital that is included within the business. Now, what does that mean? Normal, essentially it's enough money to meet your obligations. It's basically you've got payables, et cetera, and you've got to time those with how you bring in your receivables. So many days of cash, essentially. 10% of revenue, I see that as a common amount estimate of working capital. Not always the case, but and so to the extent that in valuing your center, the center has an inadequate level of working capital, then that's something that would essentially reduce the value of the equity dollar for dollar. Conversely, let's assume that the center has a surplus or excess working capital. That's something that there's a couple ways to handle that. That can be distributed prior to the transaction to bring it down to normal levels, or you can just add that to the valuation, because the person that essentially the parties that are buying in are walking into a situation where there's essentially distributable cash to be done right out of the box. So there's benefit to that. So that would conclude my 10 common mistakes. There's some slides, as I mentioned. If you go to the next slide, there's some slides here that talk about what, from our last 3 years of surveys, where multiples are trending, et cetera. And you guys, anybody on here can get to that and request a copy of that survey. Thank you.
Thank you very much, Todd, for your informative presentation. We will now begin the question and answer portion of the program. As a reminder, you can submit any questions you have by typing them into your control panel in the space labeled Enter a Question for Staff and clicking Send. Mr. Mello will attempt to answer as many questions as he can during the time we have for Q&A, and will follow up on questions he does not have the opportunity to address. And I know there are several questions coming in here, so we're really excited to be going through the Q&A portion. And as Todd mentioned, we're definitely looking forward to being able to answer any questions that you have. So feel free to enter them in there, and we'll go through and see what we're able to do. So the first question I have here is, when is it appropriate to consider the use of a multiple of EBITDA in a valuing center?
Well, again, as I mentioned, typically would not do those as a standalone valuation technique. However, if you do recall the slide with the 3 different centers where we had 3 different trends with respect to earnings, flat, increasing, or decreasing. And if you also recall the formula, which is 1 over K minus G, where G is essentially more of a long-term sustainable growth rate. Clearly, centers that are declining I'm not certain how many projections I've seen where folks would admit that their center is likely to make less next year. But generally speaking, pricing on a multiple of trailing earnings with a center that's going down is trending downwards. It should not be used. You generally want to use multiples in connection with centers that are reasonably stable to growing. If a center is growing 25% year over year for the next couple of years before it starts to level off, it probably doesn't make much sense for a multiple either, because that G in our formula is really a long-term sustainable growth rate. It's not what might be happening in the short term. So I would generally, again, not as a standalone, but it makes a lot more sense when you have a fairly stable earnings or EBITDA center. I think a multiple makes a lot more sense.
Absolutely. Perfect.
I'm going to take a look at other questions here.
Absolutely.
Okay. Go ahead.
And then let's see. I know another question we have from the audience is, let's see.
Would you like me to read that, or?
Nope, I got it. Are multiples based on EBITDA or net income?
Yeah, that was a quick one. Again, we want to be careful that we're appropriately matching multiples to the correct earnings stream. Multiples that I've discussed today are EBITDA multiples and should be applied to EBITDA and not net income.
Perfect. And then,
okay, let's see. Let's see. Okay.
And then, what trends are you seeing happening today?
With respect to multiples?
I believe so.
Okay. As the graphs will show, despite a maturing and consolidating industry, it's still very feverish in terms of acquisition activity, and lots of players still in the market, even though there's been a significant amount of consolidation. And public companies are trading at high multiples, such that they're still basically that's translating into increasing multiples within the industry. It's not uncommon for controlling interest in multi-specialty centers to go as high as 8 times, 7 to 8 times, and slightly lower on the single specialty side, just under for the reason of diversification and risk. And I expect the trend to continue for a while longer, but as long as the public markets are still valuing the public players high, they can afford to. If they're being traded 11 times earnings, they can afford to essentially acquire things at 8 times without it being dilutive, generally speaking. So, so far things are continuing to increase.
Absolutely, perfect. And then the next question: if a physician can buy shares in a facility, say less than 5% at 4 times TTM EBITDA, then what multiple would a hospital shares in the facility be worth if a hospital owns 35% of the facility, assuming the hospital provides no service or referrals to the ASC?
Well, both. Assuming, I guess the key question would be: is the hospital's 35% interest, is that controlling or non-controlling? If it's not controlling, then it shouldn't be worth any more than what the physician's interest is worth. If, however, the hospital's ownership, 35% ownership interest, has certain governing rights, for example, it can control when distributions are made, whether debt's taken on, etc. If it has certain elements of control that are not otherwise reflected in the physician's interest, then there would be some premium on that, on the hospital's interest. So If that were the case, it wouldn't be unusual for the physician interest to trade at 4 times and perhaps the hospital interest to trade at 6 or more times. But really, it really gets down to the rights associated with that interest.
Absolutely. And I just want to remind our attendees that you can submit any questions that you have by entering your questions into the space labeled "Enter a question for staff" and clicking send. And then we'll be able to take a look and address them to see if there are questions that we'll be able to address now, or we'll also be looking at the questions we're unable to address during this time and hopefully sending you answers to those questions as well when possible. So feel free to continue sending questions, and we'll continue on here. I know we have a few more minutes, so it's really great to have Todd here on the phone. The next question we have is, how often do you see real estate as part of the acquisition? Is it a separate valuation based on the market, or lease payments and terms?
Yeah, that's a great question. I would say it's definitely the minority of cases where real estate is actually owned by the operating company. Many times there's a separate LLC, real estate LLC, with common ownership of the physicians that leases the space to the surgery center company, and we want to make certain that that's at fair market value. But if the operating surgery center owns the real estate, what we typically would do is to basically carve out the asset, the real estate, and any debt associated therewith, and value the real estate separately. And then we would impute a fair market value lease rate to the surgery center. So if the real estate, we would, again, so if you have we're going to value your surgery center separately as if it doesn't own the real estate, and one of the adjustments to the earnings stream would be putting in a market level market rate of rent, and then we would add essentially the value of the real estate, or once that's appraised separately, on top of that, less any associated debt with the real estate.
Perfect. And what are your thoughts on having the buy-in different from the buyout price, or your thoughts on having the buy-in and the buyout the same even over time, lowering the barriers in the unwillingness to buy out?
Yeah, we talked a bit about this. We need to be cautious on this particular issue. Clearly, they should be about the same. I mean, again, we do not want to have a situation or create a set of facts or some sort of a paper trail that suggests that folks buying in or actually bringing something to the center are getting essentially a cheaper buy-in than the folks that are being bought out. So again, I think what we need to be concerned with is paying fair market value as of the transaction date, whether it's buying in or buying out. And I think part of that question too deals with essentially keeping the buy-in and buy-out the same over time. I mean, it's not uncommon for surgery centers to bake into their governing documents or operating agreement a formula that talks about some sort of a multiple. I mean, generally speaking, we do have our issues that we've talked about today with respect to, what are you applying the multiple to? Does it make sense? But most of these non-controlling interest valuations would generally transact 3 to 4, 4.5 times, depending upon the center. There's always exceptions. So if you had something like that in your center's governing document, so I'm going to pick a number, 3.5 times, and provided that it was very clear on what you're applying the multiple to and how you dealt with basically issues that, if earnings were expected to go down materially or go up, et cetera. You had some sort of provisions in there, perhaps, that, the standard case would be to apply the formula, but under certain circumstances, the parties may require evaluation. That's probably reasonably close. You could probably keep those generally the same over time. I have not seen them very materially. I think we get into more complexity when we're dealing with what earnings stream to apply those multiples to.
Absolutely. Next, the assumption is that owning or having a CON would increase the value of the center. Is there a standard multiple attached for having a CON, or is the multiple still based upon the center's EBITDA? Good
question. Again, we actually do report, the in our latest ASC survey, and if you don't have a copy of that, you can get one on the website or email me directly. We do report premiums associated with having a certificate of need attached. It's going to vary. It's fact and circumstance specific. It's going to vary by market. There are certain markets where there's a CON law, but essentially everything is approved. It's not a very strong CON law. Therefore, in those particular cases, I'm not going to ascribe much of a premium. Whereas in certain markets, there could be a very strict CON law. There could be moratoriums on building new centers. And in those cases, it wouldn't be uncommon to see a premium on the typical valuation multiples of north of 1 times multiple. It really is going to depend.
Absolutely. I think that definitely makes sense. And I know you mentioned this before, but I just wanted to mention again for our listeners that we will be able to send over a draft of those last slides that Todd went through with some of the information on the multiples. To our listeners here today, if you contact us, we can certainly do that, and we'll be sending a summary of the presentation as well within hopefully a week or two after the presentation. And then I also want to mention, Todd, I know the 2015 report that you have on ASCs is also on the Healthcare Appraisal website, and so that's a very good resource as well. And then, let's see here, we have a few more questions. Can a valuation be based on a replacement cost of a center impeccably built out of a facility as opposed to the multiple of EBITDA?
I would say that, again, we want to make certain that the value is based on fair market value. If the value of the center under some sort of an income approach or market approach is higher than the value of the underlying assets or the cost to replicate, then you should defer to the income-based or the market-based, which is going to be higher than essentially the replacement value. Replacement value or the cost of a center is typically going to be most applicable at startup and a center that's marginally profitable or losing money. But again, I think what everybody on this phone call needs to be concerned with is making certain that the shares are transacted at fair market value. And it's going to depend on your center as to whether that's best represented by a cost approach or through an income or market approach.
Absolutely. What are some of the key issues in valuing the single specialty ASC versus multi-specialty?
Well, as I mentioned briefly, I think a lot of it boils down to diversification, and it's going to depend what your single specialty is versus your multi-specialty. Now, for example, GI and ophthalmology centers, which comprise the bulk of the single specialty, are generally going to be valued less than, and it principally boils down to diversification. So if there's a material change to reimbursement for ophthalmology or GI, then that's essentially, it's like having all your eggs in your investment portfolio in one stock. If something happens to that, you're gonna get cratered, as opposed to having an investment in having numerous specialties where if you've got one adverse change to one specialty, the other specialties can kind of absorb that. So multi-specialty, all other things being equal, then as you'll see if you look at the graphs, is generally going to be valued higher. Now, I think perhaps one of the exceptions to that would be single specialty orthopedics, perhaps coupled with pain management. Those centers, even though we've got the lack of diversification issue, those centers continue to be valued very strongly by buyers, perhaps consistently with multi-specialty. So there's a kind of, it depends there.
Absolutely. And then from your expertise, is the EBITDA multiple or the discounted cash flow model a more popular model for valuation?
I think, again, most evaluators, us included, that I'm familiar with, that are reputable in our industry, are going to do a discounted cash flow analysis as well as look at EBITDA multiple. So our valuation conclusion perhaps may be a blending of the results of the discounted cash flow analysis and the market multiples. the market multiple, if you've got a center that's growing, again, for example, 20%, expected to grow 20, 25% in 1 year and continue that growth for a couple of years before leveling off, you might argue, that's the beauty of the discounted cash flow analysis. It lets you discretely model that out to a point where the center starts to basically approach more long-term sustainable growth rates. With a multiple, you really don't get to do that. Now, with that said, I know many of the buyers look at multiples. They probably all also run their own cash flow models, etc. But if you've got a center that's expected to have hyper growth like that, then you're going to get a much bigger multiple, because even if they were to pay you a 10 multiple, which is clearly above what those charts will show, if it's a 10 multiple on an earnings stream of $1 million that is expected to be $2 million in a year and a half, then they're effectively really not paying a 10 multiple of what their projected earnings is. So it's, again, I know I sound like a broken record, but it kind of depends.
Absolutely. And then I know we're getting towards the end here, so if there are any other questions that you'd like to ask for Mr. Mello, please feel free to send those in. I know we have time for 1 or 2 more, so it'll be great to be able to answer those and get those into the queue. Let's see, the next question that I have here is, given the robust transaction activity in this industry, what ranges of discounts for lack of marketability are you seeing?
Good one. If you're looking at market multiples between controlling and non-controlling interests, we're able to see there's a difference there, say between 7 times and 4 times. And that difference of a 3 multiple is essentially a combination of lack of control, and because again you would pay less for an investment where you can't control it, and also some sort of lack of marketability. So discounts for lack of marketability, it's always a challenging area for evaluators to quantify. I mean, there are studies out there which would assist an evaluator in trying to come up with an appropriate discount for lack of marketability. We also would look at the governing documents of the surgery center. So, for example, it's less common these days, but I've seen certain centers whereby the owners are essentially prohibited from selling it for 5 years, or there's a 1-year process of trying to sell it back to existing owners that just keeps lagging on. That would suggest that those interests are very unmarketable, illiquid, and facts and circumstance specific would suggest that in those particular cases, the discounts for lack of marketability could be significantly higher. But generally speaking, probably 15-20% for your typical run-of-the-mill center.
Absolutely. And then how often do you recommend valuation with the calculation, not a full valuation, for purposes of buy or sell or syndication if a center has outstanding shares that are available?
Yeah, good question. I think it makes sense to requisition that initial valuation, but if the shares are sitting out there for a while and there hasn't been a significant change to the center's operating results, then I generally, it's not set in stone by any stretch, but perhaps once a year, I think that might make sense. And if you're having problems, kind of a corollary to that, there are times when centers, we might value a center and then the center has issues trying to sell the shares at certain prices, and there may be an additional element of marketability that wasn't identified during the valuation. So if there's any centers out there that have had their centers valued at X, their shares, and they're just having trouble selling to new docs, there's a lot of pushback, and that's something you definitely want to share with your evaluator, because that would be some evidence of lack of marketability within the particular marketplace.
Absolutely. I think that definitely makes sense, and I know there's a lot of different issues that ASC owners and operators are looking at when they're going through and looking at buying and selling opportunities for the future. So the next question I have here, and I know there's several others that are coming in, so that's great, and I'm really glad that there are so many people who have questions for you. The next question I have is, how do you calculate risk in percentage? Are we using actuarial software to perform this calculation?
Yeah, another good question. There's a couple ways to do it. Essentially, there's an approach that we tend to use here called a build-up, whereby we start with various elements of essentially quote-unquote risk-free investments and start essentially layering on additional levels of risk and trying to arrive at the risk for the subject entity. So for example, the rate we would start with, a standard risk-free security out there is essentially a treasury bill, a 20-year treasury bill. And then you might say, well, okay, we're dealing with the equity of an individual center. That's a lot more risky than a treasury bill. Of course it is. So then we say, well, okay, the next bucket or layer of risk we're going to add onto that is risk with it being a stock. And that's another 6% roughly. There's a premium for investing in equities versus other debt instruments, and that's 6%. And then you say, well, what about the industry this business is operating? That might argue for additional risk. What about the size of the company? That would argue for additional risk. And there's data sources out there that evaluators can look at. I think perhaps one of the more, so all of those previous ones I've just mentioned, appraisers can go with reasonable intelligence, can go in and find certain benchmarks for that kind of information. That's available. It's published annually. With respect to the company-specific risk, I mean that's an exercise where we're saying, okay, we've accounted for risk in the fact that this is an equity in a small single location center. It's within healthcare, but now we need to say, well, what are the risks associated with this particular center? And that's where, for example, maybe it's out of network. Maybe it's basically it can't hold on to its physician shareholders, lots of turnover. Maybe it's heavily reliant on a workers' comp fee schedule, and most of it's 70% of its workers' comp. That's obviously much more risky if there's a change to that. So you start quantifying additional levels of risk with the expectation that at the end of the day you're trying to estimate the level of risk for your particular business. It's really kind of building blocks. There's other types of financial models that use it, but many of them rely on published statistics in combination with appraiser judgment.
Absolutely. Well, that's all the time we have for questions today. I want to thank our presenters again for their excellent presentation and all of you for participating today. We look forward to having you join us for future webinars. This concludes today's program. Have a wonderful afternoon.